think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today, we have the pleasure of speaking with Peter Boockvar, who is the Chief Investment Officer of Bleakley. How you doing today, Peter?
Good, Daryl. Thanks for having me.
Yes. I'm glad to have you on. We got connected through some mutual connections. I love going to some of these conferences in person because you just never know who you meet and then who they know and everything. So it's good to connect in that way.
I think it's a great, it's a great networking event amongst your peers, but it's also a good way to get exposure to a lot of different companies and the prospects that they have.
Yes, definitely. So you're a chief investment officer. So I've watched quite a few of your interviews and just to hear what are your thoughts on macro, micro, and such. And so being where we are now, we have a lot of geopolitical turmoil. We have a lot of things going on domestically. We have a president step down. We have assassination attempt. We got inflation. We got interest rates still high. National debt at all-time highs, right? And so it seems like we are in uncharted territories. What's kind of your assessment on what's happening and how does this impact people and investors?
Well, I think it's always important with all the things that you mentioned is to try to do your best in separating out, or our best to separate out what's going to impact the economy and markets and what's going to be sort of drama and concerns, but not necessarily a flow through to economy and markets. And markets are, in a sense, very rational when it comes to that. So, for example, when Russia invaded Ukraine, the immediate reaction was to see a very sharp spike in natural gas prices because people are worried about the supply disruptions out of Russia. We saw a large spike in crop prices, particularly soybeans and wheat, because Ukraine is considered the breadbasket of that region, and everyone was worried about the disruptions. But then when, as awful as the war has been, when people realized that the deliveries of natural gas, the deliveries of oil, the deliveries of a lot of these crops weren't disrupted, then a lot of those prices have come down. So a lot of geopolitical events end up being fleeting when it comes to markets. Now, with respect to a lot of this did flow through in inflation, of course, and that's where there could be some follow on. But I think right now, and ahead of the election, markets are really, yes, everyone's going to throw out their Trump trade, their Harris trade. If this person gets elected, this is what's going to happen to these sectors, blah, blah, blah. But I think when you look at what's realistic and what's not, let's just pretend that Trump wins. Well, the corporate income tax in 2017 or late 2017 was dramatically reduced, as we know. I don't see it going down again. And at best, with his tax cuts in 2025, when they expire, they'll get extended. So no further cut in taxes, either corporate or income. At best, they stay the same. So I think from a tax perspective, not much is going to change if Trump wins. Then we have also the possibility of a bunch of tariffs and a protectionist stance. If Harris wins, we have the risk of those tax cuts not being fully renewed, which would obviously be a negative if that were to happen. But then probably on the tariff side, we're not going to get as many tariffs. And while I do think there'll be this protectionist stance, aka the Inflation Reduction Act, it won't be as possibly as noted as maybe Trump does. I think on the regulatory side, Democrats will obviously want more of a regulatory state. Trump will want a less of one. But I think with the Supreme Court decision that overturned the Chevron case, that the regulatory situation is actually now possibly more in the hands of Congress and courts rather than the appointees of whoever's the next president. I'm getting detailed here because I'm trying to make the point that policy wise, regardless of who wins, a lot will depend on who takes Congress. But maybe things don't change that much. Therefore, I think investors should really be focused more on the trajectory of inflation, growth, um, earnings, what that means for the Fed, and that'll be the overriding driver of markets rather than politics.
Hmm. Yeah, that's reassuring to know. To hear from someone that's in the industry, because for me being a retail investor, I'm mostly positioned long term in commodities and natural resources, but I do some trading of different various sectors and companies. And just kind of going into this, like, I'm thinking about risk management. So me personally, like, I've been kind of in the T-bill and chill mode for a little while, and as some of this um, becomes a little more clear, because, like, being a retail investor, you don't want to blow up your account and get wiped out. And so what are some things that you're seeing in terms of, like, with your clients, or with people that you're working with, some things that people should be considering being in this type of environment?
Well, from a retail investor standpoint, a lot depends on, well, even the so-called professional, a lot depends on your time horizon. Uh, for young people that should have long-term time horizons, it really is totally irrelevant what happens in the next 5, 10, 15 years. And if anything, if you're young, you actually want markets to go down while you're young because that allows you to accumulate stocks and other assets when they're cheap. The problem with markets over the past bunch of years is they've been seemingly perpetually expensive. And that makes one having to pay up to own stocks. I think one issue with the markets is that even older people, older being defined as baby boomers and retirees, they have a lot of their money in the markets as well. And that sort of creates this loop effect where the stock market goes can have a direct impact on the economy. Imagine if you're 75 and you have 70% of your net worth in the equity markets. If there was a downturn of note, how would that affect your retirement? Because we're so used to, at least in the U.S., is every bear market stocks would dramatically snap back, and who knows if that'll happen again. I guess my point is that uh, looking at the markets, a lot depends on how old you are, what your risk tolerance is, and how long you can see through any turbulence. And as I said, uh, market markets do better looking out over a 10-year time frame. The cheaper you pay for something, and they tend to do less well the more expensive you pay for things. So I think everyone has to approach the market in a different way, both in terms of their style and how they want to invest, because a lot of times there's no one rule of thumb in terms of success in the markets. There's not one style that always works. One style may work for a period of time, then it may not work for a period of time. A lot of times investing is something that suits you best in terms of your personality, patience that you have, and so on.
Hmm. So you just mentioned that the not one style works, and from what I've been researching in terms of, like, with interest rates being at a 40-year low, what's your take on the 60/40 portfolio model it's been performing well over the last 40 years, and then now we currently have bonds being crushed, as well as interest rates higher. And so, what's your take there? I mean, obviously, people get into retirement funds or IRAs, 401ks, and such, and that's been the typical model. And I've been hearing a lot more about we're like more in like a stock picking, individual stock picking environment. What's your take or your assessment of that?
Well, yeah, we did have an incredible 40-year decline in interest rates, give or take some bouts of increases in between. But yeah, 40-year bull market in price and dropping yields that is seemingly over. I think it's over. I think we could have a run, a multi-year run, not just 2 or 3 years, but a further run in a rise generally in interest rates. And it'll happen in fits and starts, but it tells you that we're in a different environment, I believe, than what we became so used to, particularly the 15 years before 2022, when we had the spike in inflation and the very sharp increase in a very condensed period of time with interest rates. And I think that does change the investment calculus. Now, historically speaking, interest rates are actually somewhat normal. They're somewhat normal in nominal terms, and I believe that they're somewhat normal in real terms. Uh, Real terms being defined as, call it the Fed funds rate relative to inflation, where pre mid 2000s it usually was around 2 to 300 basis points, and you can argue that is where we should be. The problem was the 15 years leading into 2022 that was so abnormal that creates the environment where today's interest rates are very high relative to that, and that the world has a lot of debt on its books, whether it's government, business, or households, that was priced pre 2022. So in the years to come, if interest rates stay high for a while, which I think they will, or higher for a while, then we still have many years of that low cost debt repricing into higher cost debt and an adjustment period that the global economy still needs to take on.
Hmm. Yeah, and I just did the math in my head when you said 15 years. So you were talking about coming out of the Great Recession, out of the GFC.
Right, and into 2022 when rates jumped.
Yeah, yeah, yeah. That's fascinating. Looking at particular sectors, I know that sometimes, like as a retail investor, I'm looking at news headlines and such, and then we got Donald Trump coming out saying we're going to drill for more oil. We need more production. We need to put inflation to bed. There's also a lot of touting of Bitcoin and people having their own, being able to custody their own coins and such. And so I've been trying to make sense of like sectors in terms of like, okay, is this something that um, I could consider in terms of like, okay, if we're talking about more oil production, and we do see oil currently at like $80 a barrel, and it's been staying elevated for a while. We had the Strategic Petroleum Reserve being drained and such, and then now it's like, okay, where are we at with that? And so when you see a potential, a presidential candidate, coming out and saying, hey, we're going to drill for more oil. Um, I'm, as a retail investor, looking at that sector. I was looking at it before then, but it's like, okay, does this confirm my bias? So I'm kind of wondering, what's your take on like sectors such as commodities, natural resources? I mean, there's a lot of talk around uranium, rare earths and such, and each commodity functions differently, and I know that it's hard to, you have to piece each one of them out differently. But what's your take on that type of sector?
Well, with respect to oil and gas, if U.S. oil production, which is running about 13 million barrels a day, if Trump gives the green light to more drilling and the industry responds, then you'll probably get a decline in oil prices. So it may actually be bearish for the price of oil if the industry responds with more production. Now, I think he's going to be a lot more friendlier from a regulatory perspective and a permitting perspective, but the federal government really only has permitting influence on federal lands. Private lands, oil companies are already drilling as is. So I don't necessarily think it's going to have that much of an impact on oil production in the U.S. I think producers have been pretty disciplined with production. I mean, we have oil at $80, and the U.S. oil rig count keeps dropping. In fact, the oil rig count is the lowest level since late 2021. So even with high prices, it hasn't encouraged more drilling. So I'm not sure how much of an impact it's going to have there. Uh, we're bullish on oil and gas stocks, and I don't think my position is going to change if Trump wins. And we're actually also bullish on some of the things you mentioned. We're bullish on uranium and ag, particularly fertilizer stocks, and have been very bullish on precious metals, in addition to owning some copper. But I don't see those investment positions changing on our end, regardless of who is the next president, because I still think that we have many years of legacy underinvestment that is now catching up to us. And I don't think there's going to be a big boost in incremental investment over the next couple of years that would impact the price, and that there's a bull market still to be had in commodity prices generally, and commodity stocks, and especially relative to the S&P 500, which they've dramatically lagged over the past bunch of years with the market's obsession with big cap tech stocks.
Hmm. Yeah, that's good. I love to get your take on gold, but I was just reminded of the recent, um, I guess, rotation of from growth to value, and we did see a big drop in the Nasdaq and such, and there's a lot of narrative around. Okay, people are repositioning into the small caps and into the value companies. What are you seeing there? Do you see that as like I know sometimes we get these fake outs, right? Where people can get faked out and they can go long small caps and then end up getting getting wrecked. And so I was kind of wondering what's your thoughts there?
So being long small mid caps, I hope it's not a fake out. I do think the market has what I've referred to as a reconciliation period ahead of it, in the sense that prior to this recent rotation, it had such tremendous outperformance in these select few names, and everything was left for dead. But we have to keep in mind and connect some dots here that, outside of NVIDIA, that a lot of their business is within those big cap tech stocks. The other names like Amazon and Google and Meta and Microsoft, um, they do business with all these other small, medium sized companies, and they do business with the average consumer. And what we've seen data wise, and from hearing from a lot of retailers and restaurant companies, is the US consumer is very split in how they're spending. The lower to middle income consumer has been much more budget seeking and price conscious, and keeping a tight lid on their spending, while the higher income consumer is still spending pretty freely. But if you're Apple and you have an upgrade cycle ahead of you, and specifically focused on the US, well, is that lower to middle income consumer that's so price conscious, are they going to automatically upgrade to the next iPhone just because of Apple Intelligence, for example? Or may they say, you know what, I don't feel like spending $1,300 because my phone I currently have is perfectly good. So that's something that I think we'll see evidence of in which way it's going to go when they report earnings. A lot of small, medium-sized businesses advertise on Instagram and YouTube and Meta, Facebook and through Google advertising. They buy software and services from Microsoft. It'll be really interesting to hear what those companies have to say, those big companies, about their business with small, medium-sized companies. So you can't just forever be in this world where these stocks continue to do well and everything is left for dead, just from a fundamental standpoint. So that's why I'm referring to this earnings season as some sort of reconciliation, and either the big names acknowledge the softening economic experiences that we're seeing with small, medium-sized companies is reflected in their stock prices, or it's not that bad with small, medium-sized companies. They're continuing to spend, and that would substantiate the rally in the big names, but also should be an impetus to get a rally in the small mid-cap stocks. So, it's one thing to have this divergence being, fodder for conversation with technical analysts, but it's also something that I think needs to sort of connect with the fundamental investor.
Hmm. Gotcha, gotcha. So speaking of divergence, I mentioned I wanted to get your take on gold. We see gold, physical precious metals at all time high measured in dollars. Um, some people who are bullish the royalty and streaming companies or the mining stocks are still disappointed in the performance and wondering why the mining stocks aren't responding to the price of gold when they actually mine the stuff out of the ground. So in terms of like your positioning and also just looking at this dynamic, what's your thoughts there?
Well, for the streamers, I'll put that aside relative to the regular miners that get this stuff out of the ground. Streaming is a good business, high profit margins, and that's why they get rewarded with much higher multiples. Everybody else in the mining business, for decades, people realize it's a really crappy business. Uh, it costs a lot of money to get this stuff out of the ground. You have no control over the price at which you sell your product at. You're doing business in uncertain regulatory jurisdictions that a government can change their mind one day and confiscate your mine, like they did in Panama to the mine that First Quantum owned, or they can raise your taxes to a great extent. And I think investors have just gotten so burned that they feel almost it's masochistic to own a gold mining stock. I do hope, and we're long, that maybe we're in the midst of a change and that, at least for now, the cycle has turned. A lot of companies are much more disciplined with how they run their businesses, and that the price of their product is rising to such an extent that it's well outperforming the rise in their cost structure, and that profit margins are expanding to such an extent that maybe, just maybe, investors are willing to reward these stocks for the earnings performance that they're now putting up. I think that's the case, but I think that hopefully that helps to understand why it's been such a difficult investment environment for the mining space. But those that deliver are getting rewarded, like Nico Eagle Mines, for example, getting rewarded. On the other hand, Barrick Gold still lagging because of high production costs and uncertainty with some of their jurisdictions. So execution is key, but I do think we're headed to a period where miners are going to get rewarded for the prices at which they sell their product at, aka being record high gold prices and finally silver prices that are finally getting some legs, notwithstanding the recent pullback that we've seen.
Gotcha, gotcha. Yeah, that's helpful to understand. So looking at other sectors such as like real estate, and if you don't have a take on real estate, that's fine. I know that
I do.
the home builder stocks like went up drastically. I didn't put the two and two together. I was positioned in home builders, and back in 2021, early 2022, and I didn't realize like, okay, well, when people are holding to their fixed rate mortgage and you don't have supply, home builders are building homes, and those homes are coming to the market. And so I didn't expect some of those stocks to like just increase significantly to the prices that there are now. What's your outlook on real estate, home builders, and such? I know they use a lot of commodities. Uh, you still have inflationary costs, but it seems like the REITs seem to be lagging, but the home builders seem to be doing fairly well.
Well, the benefit also that the bigger builders have had is they've been taking a lot of market share from the smaller builders. The bigger builders have better balance sheets. The bigger builders have had more of the ability to discount their product, aka buying down your mortgage, adding incentives, discounting the price. That has enabled them to drive sales. Now, I think we're reaching an affordability wall where, unless mortgage rates fall notably here, even with discounting, we are beginning to see a response on the part of buyers. And monthly number that I look at is the National Association of Home Builders survey, where they ask builders how their business is. And so they talk about how their business is, but one of the questions is called prospective buyers traffic, where they tell you with a 50 level of break even between expansion and contraction. I think the last read was a 27 in terms of buyers traffic. So I think that buyers have hit an affordability wall. And so I wonder how much longer these builders, while the market definitely needs more supply, I think we've begun to see more supply. Even in the existing home market, homes are beginning to sit on the market longer. So the old rule of thumb with home builders is to buy them at one times book or less, sell them at two times book around there. And so I think looking at the individual builders, you should use that as a rule of thumb. With respect to the REITs, uh, not all real estate is painted in one brush. Obviously, office has been challenged depending on what area of office you're in terms of geographies and the type of buildings you have. But other areas of real estate in the REIT market's done pretty well. Shopping centers, for example, multifamily has had a multi-year period of strong rental growth. Now that is dramatically cooled, so we're seeing more pressure on multifamily depending on where you are, if you have more exposure to Sunbelt. But I think people can pick and choose in the REIT market. And I do think that the REIT market, which is a very small, the public REIT market is a very small percentage of the total commercial real estate industry. Commercial real estate assets total about $20 trillion. Public REITs are only about a trillion of that. And I do think a lot of them have much better balance sheets than the private market that has relied, at least the last couple of years, a lot more on floating rate debt. So I think you also have the possibility that the public REITs, depending on, again, what industry you are with that, can benefit from the distress of private real estate companies. So I'm actually positive on some publicly traded REITs.
Okay, gotcha.
And we own some of them, full disclosure.
Okay. Okay. Thanks for sharing that. Um, so banks, we have bank earnings and such. There's been a lot of concern around higher interest rates. Many banks having the bad debt the prior to the interest rates being hiked at the fastest rate. Um, that debt now becomes devalued, or those assets become devalued, and so there's still some concerns about regional banks versus the big banks and such. And so, you have any take there?
Well, it's the regional banks, depending on how much commercial real estate exposure they have, that's been a pressure point. Uh, Smaller banks are really at the end of the day in the deposit taking and loan business, and loan demand is flat at best, and the deposit costs keep going up. So regional banks are sort of in a tricky spot. Some are certainly executing better than others. The big money center banks have the benefit of capital markets, which we can see by what the markets are doing, that they've had a pretty good run of it. Uh, Obviously, you need some sustainability to that. The capital markets business is much more variable in terms of change, and all you need is a downturn in asset prices, and capital markets activity freezes up. But even for the money center, loan demand is still very muted. Banks generally have also tightened lending standards, so credit quality is somewhat mixed. But banks are being pretty disciplined with their standards, and therefore we haven't seen any notable rise, at least on the commercial side, in loan loss provisions outside of commercial real estate. Now we are seeing rising delinquencies in credit cards and auto loans. That's something that we really have to pay attention to because, as I said earlier, there's a segment of the population where consumer spending is really tight, and we've also seen a rise in the unemployment rate. So if the labor market starts to weaken, we also have to be worried about the credit quality of these banks too. So somewhat we own one bank. We own Citi. That's it. That's more of a valuation perspective more than anything. Banking has been a tough business for the last couple of decades in terms of where their stock prices are today relative to they were pre-financial crisis. So to me, that's more of a trading space rather than an investable space.
Hmm. Yeah, that makes total sense. So, couple last questions. You mentioned, slowdown in unemployment and or slowdown in employment, and so there's a lot of concerns about recession, no recession. Obviously that's been in the cards or whatnot. And so, what's your outlook there? Like, what is the data telling you, and how are you responding to the data as it comes in?
So I've been over the last couple of years worried about sort of a death by a thousand cuts type economic response to the fastest increase in interest rates in 40 years. And not everyone is affected by higher rates all at once. It all depends on when your loan is coming due. Uh, and I do think that the cumulative impact of inflation, the continued persistency in higher interest rates, again, relative to the 15 years leading into 2022, is slowly nicking away at economic activity. And now we're beginning to see softness in the labor market, which even the Fed is citing. The Fed has told us that they are now shifting their attention to both employment in addition to inflation, as opposed to just inflation over the last couple of years. I mean, the unemployment rate on an absolute basis is still very low at 4.1%, but that's the highest level since late 2021. So it's the trajectory, it's the rate of change that I'm most focused on. And signs are pointing to a weakening economy. And I think that that will continue in the second half of the year, notwithstanding one or two rate cuts by the Fed.
hmm Got it. Got it. And I want to leave off with some investment principles. Obviously, this can be, I mean, this can be subjective. Some people may go about it differently. I had recently had some some people commenting on some of the companies they've invested in, and they see the price. They believe in the uranium story. They see the price go up, and then they hold on, thinking that the move is finally here, and then they see the price come down to where to where they are, where they were, or lower than where they bought in at. And I was thinking of that question in terms of like knowing when to sell. Like obviously, depending on your time horizon, that's important. But yeah, I think that one of the struggles that people have, and which I've been learning, is like, okay, you have to have a number in terms of like based on your valuation. This is the number you have, and if you're expecting the stock price to get to that number, then that may be the number you may want to take profits at. Um, what's kind of some of the things that you've learned as far as like when to sell, when to take profits off the table, especially, I mean, right now we're in all-time highs with the Nasdaq. I mean, well, it's come down. S&P as well come down. And so, what are some of the things that you've learned there, and how do you manage that?
Well, I think investors need to understand when they buy a stock, what type of stock they're buying. Are they buying a cyclical stock, like a commodity name, like a uranium stock or an energy stock, where the underlying commodity price tends to be very volatile, and the commodity bull markets, bear markets run in cycles, as opposed to owning Coca-Cola, where you're Warren Buffett, you'll just own it forever and know that as long as there's population growth in the world, chances are that Coke is going to be selling more beverages, and that's just a owning forever type name. Or they're secular uh, tech winners that have their great growth cycles that can last many years, but eventually those businesses mature. So I think it's important to know that you're not just buying a stock, you're not just buying a stock symbol, you're investing in a business. And it's important to understand that business. Are you, like I said, a cyclical business? Are you a more of a consistently growing business that is less immune to economic cycles? Understand the business that you're in. Therefore, I think that that would help better understand the type of stock you're in and know that, is this a stock where I should be a trader in? That if it has a nice move, I can sell? Or is this a stock that I want to be an investor in, that I want to own for many, many years?
hmm Yeah, that's important to know. Yeah, because I've been like more in a trader mindset lately, in terms of I'm holding commodities long term, But I've been telling a lot of my friends, hey, I got to make some money in the meantime. So like, some of these commodities, they could take a little while to move. I mean, you get paid dividends, and such. I mean, you get paid some good dividends from some of these companies, but in terms of like the trading aspect, you can make a lot of money in a short amount of time. And then while you're waiting on these cyclical moves upward in commodities, that takes a while to play out. And so that's kind of how I've been playing it lately. So Peter, yeah, appreciate you for coming on and everything. Where can people find more about the work you do? More about you? You're on X, or are you active?
Yeah, so on X, it's at P Boockvar, and there's a C after the two O's. I write a daily missive called the Book Report on Substack, and as the CIO of Bleakley Financial Group, it's a wealth management firm, and the website's bleakley.com if anybody is interested in learning more about us.
Okay, cool. I'll be sure to link to those in the description. You all be sure to go follow Peter on X, as well as check out the Substack and the links in the description. Thank you for your time, Peter. Appreciate you coming on.
Thanks, Daryl. Appreciate having me on.